Silicon Valley Bank just collapsed. They're one of the largest 500 companies on the stock market, and they ran out of money, and now they were shut down by regulators today. Now, to put this in perspective, Silicon Valley Bank had just over $200 billion in assets. And FTX, when they failed, had right around $10 billion in assets. Now, Silicon Valley Bank was a major lender, especially to startup companies and to other companies here in Silicon Valley in California. And because of what's going on with interest rates and inflation and the economy, they've been struggling and they weren't able to raise more money, even though they scrambled to do so in the last couple of days. And because they couldn't raise more money, they had to shut their doors. They ran out of money. Now, I apologize for the quality of this video. I've been running around. I'm in LA right now. I was doing interviews today. I was actually on an interview with Tom Bilyeu from Impact Theory this morning. And we did the whole interview. And as soon as the interview was finished, one of the team members there came up to us and said, "Hey, have you guys heard of Silicon Valley Bank?" I said, "Yeah, I've been kind of following what's going on with them over the past couple of days. Actually, yesterday on Instagram, I posted about it and I said, keep an eye out on Silicon Valley Bank." Well, he said, while we were talking in the middle of our interview, they collapsed. And so I've been running around doing meetings and interviews. I just have this 15-minute block right here. So I wanted to record a video on this. I'm literally in my car right now. I got to go into a meeting right now. But this is happening right now. So I wanted to give you kind of a quick update on what's happening. That way, at least you're informed. So the issue here has to do with interest rates like we've been talking about, and particularly valuations. So over the last 12 to 18 months, we've been seeing the valuation, particularly of tech companies, get hit very hard. Why? Because many tech companies, many of these startup companies had very inflated valuations, which was very normal when you have a low interest rate environment. Because when you have low interest rates, money is easy flowing and you can easily get access to money, and venture capital firms and investment firms are fighting each other to give money to startups. And as soon as interest rates started to rise, the investment culture immediately shifted. Because before, if you could borrow money at 2 or 3%, you only need a 5% return on your money to justify the investment. Well, when you have to borrow money at 7 or 8 or 9%, now you need a 15 to 20% return on your money to justify your investment. And what's been happening is a lot of startups now are getting this pinch because the investors are saying, hey, look, we can't keep throwing money at you. We need you to generate a profit. And so the startups are saying, oh, this is a tough time to do that because one, the economy is slowing, so it's harder for us to increase our revenue. And if you can't increase the revenue, what's the alternative? Well, you can cut costs. This is why we've been seeing a lot of layoffs across Silicon Valley and tech companies, because it's a way to cut costs to continue servicing the debt. Now, sure, you can do that if you're Meta, if you're Alphabet, if you're one of the larger companies, but what if you're a startup company? What then? Now, we've been kind of covering what's been going on with the smaller startups on market briefs, but a lot of startups have seen their valuations crumble. And that's bad news for investment firms, companies like Silicon Valley Bank, because the way that they work is they have a balance sheet, and your balance sheet is essentially your net worth statement as an institution. And so for a hypothetical, if you invest in 10 different startups and each startup is worth, say, $1 billion, well, now you can show a lender, look, I have these 10 assets, each one worth $1 billion. So I have a balance sheet, a net worth of $10 billion. And now you can go raise money based off your $10 billion worth of investments, of assets. And so if you do a 80% loan to value fund, that means they might be able to raise $8 billion because they have invested into these companies worth $10 billion. Well, now as interest rates have been rising very quickly, the valuations of things, particularly tech companies, have been getting slashed. And so you have some of these smaller tech startups that go from $1 billion valuation to a $500 million valuation. That's a 50% drop in valuations. So now you have banks with their balance sheet, which is now getting cut in half, maybe even more in some instances. And so you might have $8 billion worth of debt on the books, but your assets are only now $5 billion. Because the valuations have dropped so quickly. And the reason why valuations have dropped is because interest rates have been going up. So now the higher interest rates are putting pressure on all the investment institutions saying, We need more money. We need to show a profit from these startups, and the startups are struggling to do so because if you're a smaller company and you cannot find a way to make money, you might be forced to shut your doors. And we've been seeing a lot of these smaller startups forced to shut their doors, do layoffs, while the valuations have been tanking. Now, of course, we're going to be covering this entire story even deeper on Market Briefs, my free financial newsletter. If you haven't joined Market Briefs yet, I'll put the link to how you can join. It's completely free down in the description below. But this is where now, what does this mean? Well, the economy has been slowing. We're seeing some impacts of that. This is a pretty recent big impact. This is one of the largest banking failures since the 2008 financial crisis. But then on top of that, we still have extremely high inflation, and interest rates are gonna have to go higher. Higher interest rates have more impacts on the economy. Inflation is still closer to its high peak than it is to the goal of 2%. At the same time, interest rates have shot up and they haven't gone high enough yet. Jerome Powell gave a speech in front of Congress earlier this week. And what he said is that interest rates are gonna have to go higher. And the reason why they're gonna have to go higher, and potentially even higher faster than expected, meaning he might have to be more aggressive with interest rates, is because, well, inflation isn't coming down. And the thing that Jerome Powell kept getting grilled on was, if you keep raising interest rates and unemployment goes up, which is what the Federal Reserve Bank predicts, the Fed predicts that unemployment will go up to around 4.6% by the end of the year. This is the Federal Reserve Bank prediction. If that happens, that means roughly 2 million Americans will lose their jobs by the end of the year. This is the Federal Reserve Bank prediction. Now, what you have to remember, the Federal Reserve Bank has been wrong many times. They first said inflation is not going to happen. Then when inflation happened, they said it's transitory. Then when they said it's transitory, they said it's going to be easy to bring it down. Now they're saying it's hard to bring it down and it's going to cause some pain. Well, on the economic side, they're saying that we can have the soft landing and we're going to see a couple million Americans lose their jobs and that'll be the end of it. Well, take everything you hear with a grain of salt, even if it's from a random guy on YouTube. Take everything you hear with a grain of salt, because the reality is bringing inflation down is not going to happen without pain. And that pain is going to be in the form of job losses. It's going to be in the form of bankruptcies. And, this is just, it's funny. You read the articles about Silicon Valley Bank and almost every article says that this is contained. This is not something to worry about. This is not going to spill over to other parts of the economy. This is contained to the tech sector. And yes, the tech sector is the most susceptible to the higher interest rates. Sure. But every part of the economy is going to be facing pain. The thing is, we haven't seen interest rates grow this quickly in a long time. And we haven't been in a rising interest rate environment in many, many decades. Since the 1970s, interest rates have just steadily been coming down. Sure, you have periods of ups and downs, but since the 1970s, interest rates have just been going down. And now interest rates are starting to go up. And we've been so accustomed to this free and cheap money. There is going to be a cost to getting used to this more expensive money. We have more debt than ever, more national debt than ever, more corporate debt than ever, and more household debt than ever, at a time where interest rates are growing at some of the fastest rates ever, and they're going to have to continue to go up and stay higher longer than expected if we want to get inflation down. This is where what I'm trying to get you to understand is, one, be aware of what's happening. We try to keep you posted with market briefs. Second, be educated. That way you can protect yourself. But third, also understand this is going to create a lot of opportunities, but you got to be patient. A lot of people have no patience and they assume that if we don't see any sort of pain within 6 weeks, everything is fine. But that's not how it works. You have to be patient and understand that there's a lot of red flags happening right now. And these issues are not just going to magically go away. And just because somebody says we can have a soft landing doesn't mean it's going to necessarily happen. In 2007, 1 year before the real estate market collapsed, Ben Bernanke, who was then the chairman of the Federal Reserve Bank, kept saying that we're going to have a soft landing. Before that, in 2005, he said that there was no housing bubble to burst. In 2007, he said, sure, we could potentially see a housing bubble, but it's contained to the housing market, and we expect a soft landing. Now, we're hearing talks about a soft landing again, and this is where I want you just to understand inflation is a problem. The higher interest rates are necessary to bring down inflation, but they're going to come with pain. And the economy is going to go through its own slowdown. So this is not the year to go out and finance a brand new truck that you can't afford. This is the year to really get financially educated and understand what's happening. All right, well, that's what I got for today. I'll see you guys soon.